Hey everyone, this is Kirk here again at optionalpha.com, and welcome back to the trading recap video that we do here each night on the membership side of our website. Had a lot of closing trades as we get close to the end of January expiration this week, and then just one new trade today. So I want to go over a lot of these closing trades, but before I do, I want to go over the opening trade that we had here today on Netflix. Now remember, if you're a member at optionalpha.com, you can get these videos each night following all the trading alerts that we send out. If you're not a member at optionalpha.com, then you are likely viewing this video on YouTube about 5 to 7 days later. So you can't take advantage of these trades as far as the new trades that are opening and then the trades that we also close out for profit, loss, etc. So let's go over this Netflix trade. And today we made our one opening trade was on Netflix, and that's because Netflix had really good implied volatility. And so what we did here with Netflix is added to some of our February vertical credit spreads that we already have. And on Netflix, we had sold the 305 puts and then bought the 300 puts. And we took in a total credit of 130 on the spread overall. So again, the reason that we did this is because Netflix has really high implied volatility right now. Again, I'm going to go to the chart just so you guys can see that. So you see the Netflix right now is kind of trending lower as it heads towards earnings. And yes, we are trading this around earnings, so implied volatility is higher. And right now it's above the 52nd percentile. So again, that meets our criteria for trading credit spreads in that it's above that magic 50th percentile as far as implied volatility ranking. And I think today actually was a little bit higher, and it kind of came down at the end of the day as Netflix rallied towards the close. But that's the reason why we decided to choose this strategy, and that is a credit spread. Now, what side of the market? And that's just because we did the put side is only because Netflix has had just a really rough time over the past couple weeks. So we think that it's due to possibly kind of bounce here before earnings. At least that's what it's usually done historically. Historically, earnings on Netflix has been fairly good recently. So we think that it's overdue for a nice little bounce and correction. And when it does that, that's going to help with our position, both with a drop in implied volatility and just directionally moving higher. That's going to help our put spread as well. So if we actually go to the trade tab, this is really where everyone gets excited about where the positions are. So why do we choose these strikes? How do we know what our probability of success is? Well, again, if you look down in the bottom left-hand corner of your screen, we always have the trades posted down here below, so you know it's a live trade that we made here today. Now, the reason that we chose the 305-300 strike is because that is the first level at which the probability of being in the money is about 30%. And that's the range that I like to use, is that 30% probability level right here. So I know that I'm trading with 70% chance of success. So if there's about a 30% chance that this stock or Netflix is in the money, meaning that it's trading lower than 305 by expiration, if we just take the inverse of that, then we understand that there's about a 70% chance that it doesn't trade lower than 305 by expiration. Again, because we have volatility on our side, that obviously really helps our position. So we'll continue to hold this position all the way through expiration if need be, or until it shows a profit, as we always do here. All right, so let's go over some of the closing trades that we had here today. I'm not going to go over each and every chart, but I will go over a couple of the key ones. But here, really the whole idea with closing a lot of these trades out is that as we get closer to January expiration, some of these have already shown a profit, and some of them have already had a kind of a full loss here. So we kind of want to save part of what we can get in premium because they're just so far out of the money or so far away from where the actual strikes are. It doesn't make sense to roll anything at this point. And so I'll go over a couple of those with you guys here today. The first one was on Herbalife, and this is one I want to go over with the chart as well. But you can see we sold back the put spread that we bought in Herbalife for a $111 loss. We bought it back for a 19-cent credit. Again, the whole idea here is that our strikes were at 77.5 and 75 on the put side. So if we actually go to the chart of Herbalife, which is here, you'll notice that the stock is trading much higher than our strikes. So our strikes are somewhere right around this neighborhood. And so in the next 4 days, we would need Herbalife to really kind of drop significantly below our strikes for us to start to make money on this trade. So at this point, there's 19 cents left in it. We took a loss of $111. So it is what it is. It's part of trading, and this is what the name of the game is. You got to take some of these trades off, and some of them are going to be winners, and some of them are going to be losers. All right, so Twitter, we bought back our vertical call spread in Twitter today. We bought it back for 40 cents debit, which is a little bit higher than what we want to pay. It only made a $20 profit per spread, so a nice $60 round profit on the whole trade here. But really the whole idea with Twitter is that it's an extremely volatile stock. It could jump at any moment, and it's actually starting to rally more and more each day. So I didn't want to run the risk of this trade going in the money at expiration just barely and taking a full loss on it. So again, take the trade off. It's now showing a profit, not as high as we wanted, but as we get closer to expiration, it's time to exit these trades. The vertical spread on the Qs has been very well for us. Although we've had a kind of dip in the Qs here today at the end of the day. We took this trade off early in the day, and it was the Qs 86.87 vertical call spread that we sold back to the market for 75 cents. We bought it for around 50 cents or so, so we made a nice little profit of $18 per spread on this. Again, this is purely a directional trade that we made. If you go back to the video archives, for those of you who are members here at optionalpha.com, you'll see that when we made this trade, since we paid about the midpoint of the width of the strikes, which is just $1, so we paid about 50 cents, you'll notice that it's purely a 50-50 bet. So at this point, because we have a profit, we've already beaten the odds, and so we're starting to tilt those odds in our favor long term on a 50-50 bet. So because of that, we just took the trade off again as we get close to expiration. FXE, this is another big one that we took off here today, $43 loss on this one. We had the 137, 136 put spread, but we sold it back to the market for a 95-cent credit. Again, I'll go to the chart of FXE because you'll see that the security is just not even close for us to be rolling it at any point. So is this the one that we had traded here? Yeah, let me just double check. Yeah, the FXE 137, 136 put spread. And again, you'll see that it's all the way over here. So our put spread was deep in the money. We thought it was going to continue much higher than that. So again, we just exited the position. All right, so UNG, we have a couple positions on in UNG currently. Sorry, let me jump in back and forth here. We have a couple positions on in UNG right now, and we took one of them off here today, and that was that we bought back the vertical call spread, the 21.22 call spread for a 14-cent debit. So again, we sold this for about 30 cents, which is usually what we do with these call spreads. This is a great example of taking trades off, managing these winners. So we sold it for 30 cents, we bought it back for 14, made a $16 profit per spread. But again, we made 50% of the potential profit that we could make on this trade. Now, why did we close this trade out? It's obviously getting very, very close to that magic figure as we get closer to expiration. That's because UNG had a huge move up here today after continuing to be what looked like a new downtrend in UNG. So what looked like a new downtrend just the other day kind of broke these support levels, then it just comes right back up here on top. So again, our strikes are right above here, so we just wanted to close out this trade and hopefully salvage some profits here. We've got one more position on UNG, and we'll look to kind of manage that trade here over the next couple days as we head towards expiration. All right, so the next one that we have on our list here tonight was Priceline. Priceline was another loser that we tacked up here at the end of the month. We sold back our put spread, the 111 or the 1120, 1115 put spread for 72-cent credit, a 183 loss on the spread overall. Not too bad of a loss, small position as always. We always trade here small at optionalpha.com. But again, the whole idea here with Priceline is that it's not worth rolling. It's just too far away from our strikes right now. It's better just to open up a new position if you wanted to. All right, the last trade that we have here today that we closed out was BX, which is the Blackstone Group. And we closed out that vertical call spread, which we bought back. So we originally sold it, sold the vertical call spread, the 30-31 call spread. We now bought that back for 97 cents, so it was a $63 loser per spread. So again, let's go to that one, BX, and you'll see exactly where the strikes are to where we had actually sold it. So again, you'll notice we sold the call spread back here in the beginning of December, the 30-31, which are these strikes right here. My highlighter would work. So it's right about here is where we actually sold the call spread, our first strike. So again, you can see that the stock has just been really, really resilient. You can't really beat that. I mean, unfortunately, you just have to make some trades, and this is why we always trade small, because at some point we think this thing is going to come down. It just didn't come down in the time frame that we traded options, right? That's always one of the tricky parts about options, is getting that timing right. So keep your trade size small. You can afford to take losses like this because we've taken a ton of profits over the last month. And so now we're starting to get towards the end of the month where some of the trades that we had on aren't working out. So we're, again, closing them out for a loss before they go into the money, before they get exercised in the next couple of days. So hopefully you guys enjoy these videos. As always, please add your comments right below this video. I'll get back to the members' comments first. And as always, happy trading.